So, hey guys, welcome back to Accelerated Investor. I'm your host, Josh Cantwell. And listen, if you're not following me, if you're not connecting with me on social media, man, please do that. Go to Facebook and find me online, Josh Cantwell. Go to LinkedIn, find me online, Josh Cantwell. Go to Instagram and connect with me. Go to our YouTube channel and connect with us, because I do this really for you guys. I do this to find deals. I do this to network with investors and just really have a good time with it. Today, I have a brand new guest and a brand new topic that I really, really enjoyed. My guest today is a gentleman named Flint Jamison. Flint spent 20 years in aerospace as an engineer and a program manager and managed a $120 million program modifying aircrafts for the military. Back in 2018, he decided to build a new financial future with cash flowing multifamily real estate. So he's been at this for over 5 years. After buying his first duplex and getting a hard money loan and a construction loan and doing that, he realized that that was a lot of work and he didn't want to buy himself another job. He thought, hey, if I got to do this 50 times, there was no way I was going to buy myself 50 more jobs. Okay. And so he decided to get into syndicating multifamily and build to rent communities. So in this episode of Accelerated Investor, you're going to learn, number one, you're going to learn about the 3 phases of doing a build to rent community. Phase 1, phase 2, phase 3, and why each phase that property is worth more money. You're also going to learn about number 2, what does yield on cost mean? Number 3, you're going to learn why the relationship with the builder is most important. You know, builder who can handle zoning, objections, laws, demand, and the style of the house that you're going to build in a build to rent community. You're going to learn about that. Also, you're going to learn from Flint about, again, why there was no way he was buying himself 50 more jobs in the residential. And finally, you're going to learn why Flint's Investors Unlimited partners have broken free from the Wall Street roller coaster and found true financial peace of mind through multifamily investing, syndications, and build to rent communities. You're going to love this interview on Accelerated Investor with the CEO of Vestus Capital. His name is Flint Jamison. Here we go.
Welcome to the Accelerated Investor Podcast with Josh Cantwell. If you're looking to retire early with forever passive income, you're in the right place. This podcast is the go-to destination for real estate investors, both active and passive, and multifamily apartment investors, both new, intermediate, and advanced. Now, sit back, listen, learn, and accelerate your business, your life, and your investing with the Accelerated Investor Podcast.
So, hey, Flint, listen, thanks for carving out some time today to be on the show. I'm so excited to have you, man. Talk real estate, talk about your pivot from being an engineer into commercial investments. Thanks for carving out a few minutes for us. How are you?
Yeah, thanks, Josh. Thanks for having me.
You bet. You bet. Flint, listen, with every guest that we have on, I always like to first talk about, what they're up to right now. Like, what are they excited about? What passion projects are they working on? So as we introduce you to our audience, tell us a little bit about what what gets you going. What are you passionate for in today's market?
So a couple of things. I quit my day job in January. So right now it's a really good time. I've got a few deals I'm working.
You're doing nothing today. Like
I am just, taking kids to the doctor this week. I mean, all sorts of stuff. The freedom is really great. But a couple of things I'm excited about. I'm raising on multiple deals right now. I'm super excited about build to rent. We got 3 properties going. And then I'm actually raising on a 94 unit townhome community. All of this is 506C, which is allowing me to talk about it, obviously. But raising capital.
Nice. I love it. Fantastic stuff. So you mentioned build to rent. So peel back the onion a little bit. What does that look like? How big is it? Tell us a little bit about that.
Yeah. So we'll go to the basics because I think this is still a relatively new topic for most people. But think about it like multifamily crosses single family homes. So we build a community of single family homes. We manage it as one large commercial property. So say 160 units in Foley, Alabama. It's smaller starter homes, like 1,400 to 1,800 square feet. It's a nice middle ground where millennials who are looking to get out of apartment buildings, they're growing families, but they can't afford a house. Everybody knows housing prices are super high. So this is the best compromise. We're building these brand new houses, starter home size. They can get in, they can live in a home with their own four walls, a front yard, a backyard, amenities, property management, maintenance free, right? You call the maintenance guy. So it's kind of this really, really wonderful middle ground that is causing so much demand. The big institutions want to buy these up, but they aren't building them. So we're here to build them.
Is that the plan then, to build it, tenant it, fill it up, manage it, and then sell the whole community?
Yep. So on this particular one, we'll build it in 3 years. We'll stabilize for 1 and sell. But we're also seeing unsolicited offers for much sooner than that. Like we could be 60% built and we'll get offered to get bought out.
Tell me about the economics of it. Like what does it take to build one of these starter homes? Like, what do you think you'll kind of be all in for? And then what do you think the exit price looks like?
Yeah, we could break this down in so many different metrics. The easiest one to think about is, let's say it costs $30 million to build this 160 unit apartment complex, and we're probably going to sell it north of 40. If you think we're leveraged throughout the whole bit, we're getting 20% IRR or higher, or up to 25. I like to stay on the lower end because it's under promise, over deliver, but some of our internal underwriting is really exciting when we put in numbers that are realistic, which we don't advertise to investors.
Sure. Love it. What is the, I love the build to rent. We're not doing any of it ourselves. We've done 19 syndications, but we've never done a build to rent community. I love the idea of it. What does the capital look like for that? I'm curious, just for my own kind of selfish reasons. How does the stack look? The bank, the construction loan, the investment?
So it's Arbor construction loans. It's interesting because we normally get in multiple phases, right? You buy the land and you got to entitle it. As most people see, that's the riskiest part, getting the entitlement, because you could get voted down or it could take you 3 years to get it approved. We're bringing in investors in what we call phase 2. We're past the entitlements, engineering's approved, and we're starting to cut dirt, as in horizontal. We say phase 2 is a horizontal. We're cutting the dirt, putting roads, sidewalks, and utilities in. Phase 3 is going vertical, putting in the houses. So at each one of these phases, we'll get a new assessment on the property, and then we'll go get another loan. And at each phase, the property is worth more. If we have roads, sidewalks, and utilities in there, all of a sudden we're valued much higher, and we'll go get another loan. And the investors, the earliest investors, get in there, and every phase, their equity is worth just that much more. But it's largely builder loans, construction loans.
Got it. Yeah, love it. That's fantastic stuff, especially with the housing shortage that we have, like the lack of supply. It's a lot of people that are going to rent, the people that don't want to pay a 6.5%, 7% interest rate on a mortgage right now. Maybe they'll rent, they have a nice full house, kids in good schools. And then whenever the time is right, they can go buy something. Although I don't think prices are going down to purchase anytime soon because of the supply.
Huge shortage.
So love the strategy. Fantastic stuff. How did you get into that? Tell us me a little bit more, Flint, about is this something you fell into? Is it something you're like, I love the idea?
Yeah. They say network is your net worth. So you're probably going to ask this question a little further on, but I'll get there early.
Yeah.
I initially started syndicating back in 2021. I failed on my first syndication with partners. That's a whole nother story. But out of that, I targeted my weakest point, which was capital raising. So I went and got coaching. And then I became a capital raiser working with experienced operators. So my friends and family who were investing with me were getting in with experienced operators. Mm-hmm. I found myself serendipitously as a capital raiser from that point on, because I could bring my friends and family a diverse portfolio with experienced operators all over the place. So here I am. I've been networking with all sorts of people, all sorts of operators. One of my good friends started doing build to rent. And this is like a marriage between syndicators and a housing builder. Because, well, you have to build houses. So you go find a very expensive, experienced housing builder and you create a partnership. So syndicators bring the capital, the housing builder builds the houses, and everyone, it's a win-win. And I've just known these guys for a while. They said built to rent. I said, no way, I want in. So I got in.
Nice. I love it. I love it from also a cost to build scenario that community could be turned over and sold off. You know, you can do it and sell it off that way. But
the exit strategies are really good. Like if you look at an apartment building, there's multiple exit strategies we have, but you still have to sell it as one big property. Built to rent, you have a bunch of single family homes. You can parse them off as either, I say the worst case scenario is sell them off just to individual buyers. I think a better solution is sell them off to other investors. Like somebody can come in and buy 5 of the units, but you still keep that property management in place and all the amenities and everything. So there's multiple exit strategies beyond what you would normally see with an apartment building. And
Flint, how are the lenders with this? Like very receptive? Are there certain lenders already in this space that are very bullish on it?
The lending is actually favored. Like Arbor loans, they love construction loans. There's some, if you pull back the curtain a little bit, Blackstone is wanting to invest in these properties because they see so much value in it. And they turn around and they will invest with Arbor, say, here's $10 billion, go lend construction loans to these built to rent communities. So they're lending to Arbor to lend to us to ultimately circle around and buy this property from us.
Oh, so Blackstone then is like the possible takeout buyer? 4 or 5
Yeah, absolutely. These big institutions are takeout buyers. Yeah.
No kidding. I did not know that.
Yeah.
So Blackstone's giving Arbor some sort of line of credit or some sort of funding. Arbor then some sort of spread. They lend the money out to you in 3 phases described. You wrap up that build, or maybe you're 60, 70, 80% through it. Blackstone circles back around and says, great, let's just buy the whole community. And then we can obviously deploy the money. We can put our money in play, get a good return plus the depreciation.
Yeah. Let me give you an idea of the amount of demand. I have a friend that did a 600 unit. They bought the land, investors came in at the land purchase. They spent 18 months entitling it. And then they got 2 unsolicited offers. They didn't even cut dirt, and their investors doubled their money in 18 months. Because an investor came in and said, that is worth so much money. They wanted it even before it even got roads.
Got it. Love it. And the guys that you knew that got into this, like, how did they get into it? Like, what is the same thing? Did they kind of follow their network?
No, one of the guys has been around real estate for 20 years and done some development stuff. And he had relationships with builders, and he ended up in the syndication world doing the multifamily value adds. And he kept saying, hey, we should go do this development thing over here and build some houses. Build to rent's a big thing. And so it took a little bit of motion, a year or so, and then finally gained traction with the others and said, all right, let's do this.
Love
let's go build.
How about Flint, your investors? Tell me a little bit about, you syndicated for a while before that. You said you had a failed syndication, et cetera, but you've done some syndication, then decided to get into this. How did your investors respond? What was their response to seeing this type of opportunity versus like a value add B class, C class apartment complex?
Yeah, it is a bit of a sell. I think, to be honest, the economy is making it a challenge to raise capital, period, whether it's a value add apartment building or new development. We are seeing investors who, they just want to see cash flow, even though we're seeing cash flow on cash flowing properties in the first year is like 2 or 3%. It's not much. And in a development phase, you got to go in and say, this is a long haul. You don't have any cash flow for 3 years. We'll likely cash flow sooner. Once again, another benefit of build to rent. As soon as you have homes built, you can occupy them versus a apartment building. You have to be 100% complete, certificate of occupancy from the engineer, et cetera. In this case, if we have 10 homes built, we'll fill them. And then we'll continue to build the rest of the 160, and it's a wave. And so there will be some cash flow, but we just say no cash flow for 3 years. But the yield on cost is super high. You get really great returns. It's like buying the seed that you plant the apple tree, and all of a sudden the apple tree is producing apples that you can sell for $1 a piece, right? It's just, the seed costs you pennies.
Yeah.
It's just a little bit of a mind shift.
Let me ask you, it's like a selfish question.
Yeah. Yeah.
I started this podcast just to meet cool people. I didn't care if I had an audience at all. All right. Now we have a big audience and they still know I'm super selfish. Hopefully they get a lot out of the questions that I ask for my own reasons. So I've done all these syndications myself. I've never done build to rent. Where would I start? Like, I know I can raise a lot of money. I know I can sponsor big loans, all that,
Yeah.
but I don't even know the first thing about, like you said, find the dirt, entitlement.
Yeah.
Where would I even begin to evaluate a market?
To be honest, I think the smartest thing to do is build a relationship with the builder, because I think they are the strongest key to the whole thing. Our builder has built within a 4-hour radius of where he lives for so many years. He knows all of the local municipalities. He knows what it takes to get zoning approved. He knows what the rejections or objections would be. He knows all of the laws, right? So, and then on top of that, he's been around the area so well, he knows what the demand is. I mean, we can do all our standard market research. What's the market demand, the market growth, right? All that's the same. But this builder knows how to take a piece of property, and he knows the area so well, and he knows how to convert it into houses.
Yeah.
I think that is the first place to start, because they are the key to make it successful.
Yeah, that's great advice. That's great advice. And I've got some relationships with some pretty substantial builders. So I'm gonna start there and talk to them. Like, as we continue to look at some of the challenges of today's market, which is what I wanted to ask you about next. You got to be a little bit more creative in finding deal flow or creating deal flow. Whereas in a year or two ago, there's deal flow everywhere. Now there's still deal flow, but a lot of it doesn't pencil. So you have to kind of make some deal flow where it didn't exist before. And obviously new construction is one way to do that.
Are you ready to automate and explode your real estate investing? We're searching for extremely motivated individuals who are sick and tired of wasting time and want to finally see real results from their real estate investing business. We're searching for investors looking to get to the next level and become a bigger, better version of themselves while being a more successful real estate investing entrepreneur. Apply for mentoring and coaching at joshcantwellcoaching.com/podcast. That's joshcantwellcoaching.com/podcast.
Flint, when you look at this type of investment, or you look at the economy as a whole, is there anything that concerns you? Is there anything that keeps you up late at night? Or what are you doing to de-risk your business that, based on some of this recession stuff, this rates,
It's
unemployment, what are you doing to kind of compensate for that?
Yeah, to me, I view the recession, looking at history, recessions only last on average like 9 months or something like that.
Right.
I kind of wish they would just have called the recession last year just to get it over with. Because I think the way we get out of a recession is people just get tired of calling it a recession and they move on with their lives. And lo and behold, the economy comes back alive. Yeah. But we've kept ourselves in this funny stalemate for a while. Like, oh, we're not quite in a recession and the economy's not quite great. Obviously, the interest rates have gone crazy. They're not going to last forever. Real estate is a long game. Get in it and find a property that can withstand the long game. Like this 94 unit townhome that we're doing in Columbus, that's a 10-year fixed debt at 5.6%. We have a decade to weather some storms and find a great exit strategy. I think that's a great plan. To your point, it's hard to find some of these opportunities because the interest rates are high. We create, okay, let's go just do new development. A really great yield on cost. But to the investor side, people are struggling to commit, right? There's the media is throwing the scaries out. People just want to sit on their cash. That's a hard one to battle. To me, it's like the banks aren't super healthy. I'd rather have my money in a tangible asset. If you play it right, you can invest in the right deal and secure your money for great returns over the long haul. This is a bump in the road. I mean, in 2 years from now, we'll look back and be like, oh yeah, that happened. Kind of like COVID, right? I invested in the middle of COVID and I am glad I did.
Yeah.
I am going to be super happy that I'm investing when I'm investing now, because in 2 to 5 years from now, things are going to explode.
Yeah, and almost every podcast I'm doing lately, I want to make sure my audience is really educated on, how do you get trapped in real estate is by having to refinance or sell at the wrong time. And the reason for that is because people don't secure long-term debt. That's why we got in trouble in 2006, 7, 8, because of all the short-term adjustable rate mortgages. Same thing in 2022, where a lot of multifamily investors used variable rate bridge loans. They get caught. It's because they have to sell, they have to refi at the wrong time. As long as you secure long-term debt, and long-term, I mean at least 5 years, but you're really talking 7 to 10 years or longer. 5 years, I would consider kind of mid-grade or midterm financing. But 5 years at a minimum. And that's probably the best thing we ever did over the last couple of years was get mid or long-term financing, and whatever happens the next year or two really won't matter. We can refinance if we can, we sell if we want to, but we don't have to do anything versus these other guys that are getting caught. So I really, really love that. When you look at limited partners today who are maybe pulling back a little bit, but should still be investing, especially with inflation so high, they need to get a 6, an 8, a 10% return just to outpace inflation. What message, like when you have a call with one of them, what are some of the bullet points maybe that you use, or some of the talking points you use to try to get them off the fence? So I'm asking you this question for two reasons. One is our audience who are operators that are having the same problem, giving them some advice about what you do. And secondly is, if you are a limited partner, like you can't be sitting on the sidelines. You can't just keep your money in a money market. You're going to get hammered the opposite way. You're going to be losing 5% per year. So are there any talking points or things that you say that you think are working?
No, because I think everybody has a different objection. And so part of the thing I struggle with is I'm an engineer. 20 years is engineering experience. My avatar, my target market is engineers. They're naturally skeptical, and they're naturally analysis paralysis. So sometimes it could take 3 years to convert someone. And you just got to have that heart to heart. What is their pain point? Stock market volatility. Okay. Real estate over the last 100 years, it has ebbs and flows too, but it is statistically shown it is far more stable. I like investing in the basic human need of shelter. You're investing in a tangible asset that people have to have. I think that's far more stable than whatever is driving the stock market, because I haven't figured that out yet.
Yeah.
Or I don't know that I ever will, because I've shifted to real estate.
Yeah. I love it. I love it.
Yeah.
But tell us a little bit more about your start. You obviously had a very long and successful career in aerospace as an engineer and a program manager. You managed $120 million, so big contracts with the military. Like you said, engineers tend to have very analysis-driven minds, so analysis paralysis. So making a move in 2018, like you did, to pivot over into real estate and do your first duplex and do your first multifamily type of deals. Naturally, as an engineer, I used to be a financial planner, and anytime I would have a meeting with an engineer, I'm like, shit, this is going to take like 8 meetings to get this guy to do it.
Yeah.
It probably used, because I know how your mind works, your mindset works. It probably took you some time to convince yourself to even make the move. And then the move, then you have obviously the hiccups and challenges of being a new investor. Tell me about your mindset during that time and some of the early challenges.
Yeah, well, the way I got started was listening to Bigger Pockets. And I bought a duplex. That was my first thing. I educated myself for almost a year, and then I jumped in, I burred a duplex. After that duplex, I mean, the burr was hard. I spent a lot of money. I did a hard money loan to buy it cash because it was super distressed. And then when it was all said and done, I said, wow, that was a ton of work. I basically bought myself a job.
Mm-hmm.
And then I did the calculations. What's it going to take to become financially free? Because you always hear about somebody's uncle owns a ton of real estate and they don't have to do anything because they just get passive income. And that's where I was, oh, that's where I want to be. But when I did the calculation, I had to do that 50 more times. I needed 50 more doors. Like, there's no way I'm going to buy 50 more jobs. I mean, yeah, you can systemize it and hire more people, but I was like, this is going to take me forever. And then I discovered syndications, which was advertised as the most efficient path to financial freedom. After digging in, I'm like, holy cow, this is like, you get a team of people to help. You don't have to be the expert in all things. You invest with other people's money so you can really scale. You get these bigger complexes. Everything becomes very scalable, and it just all of a sudden becomes more efficient. And it's a wonderful place. The tax depreciations are great. So I think as soon as I recognized the full picture, that's when I said, all right, I'm in.
Yeah, I love it. And what about that first deal? What about that first couple of deals that you were like, okay, syndication's the way to go? What did you find that worked for you? Maybe being an engineer, was underwriting easy for you? Was that fun with your analytics?
So to be honest, I'm so tired of spreadsheets that yeah, I can do the underwriting, but I just don't want to do it. I say that, but then on the flip side, like personal budget and stuff, I'm like, oh, let's do a spreadsheet. But I kind of fell into the capital raising thing, and I'm loving it. It's weird because I'm not a sales guy. I'm not a marketer. I'm learning how to do this stuff. But I think a lot of people relate to me because I don't know how to be that car salesman. All I know how to do is educate. And I think a lot of people really appreciate that.
Yeah, no doubt. I think that's the big takeaway. And we can probably wrap up with that. I think education, when you know something, I had a friend of mine, Flint, I've used this before on the podcast a few times over the years. I had a friend of mine, his name was Francis, who told me one time, he said, listen, if you have something that you know that's going to help other people, and you know that they're going to be better off with that product, that service, that program, whatever it is, then you have a moral obligation to sell it to them.
Yes.
Right? A moral obligation. That's the word he used. And I was like, wow, that is powerful, man. And then you realize you don't really have to sell. It's just education. The market has so much money educating the market about traditional investments, stocks, bonds, mutual funds, because that's where the commissions are and the fees are, right? There's just not a lot of marketing dollars or education sitting behind syndication. So then you, guys like you and I, guys like our audience, we have to take the bull by the horns and we have to educate the market. And as soon as the person, whether it's a one-on-one call, a webinar, a live event, whatever, as soon as they learn about this, it's like, there's not many people that are like, yeah, that's a dumb idea, right? Like nobody says that. It's like they're either really interested or mildly interested or interested in learning more. Maybe the timing's not right, but nobody ever says it's a dumb idea. So really our job as syndicators or capital raisers becomes, how many people can we educate?
Yes.
It's all it comes down to, really. It's a numbers game of how many people can we talk to? How many people can we educate? They may not invest today, but they're going to invest in the future. And you know what? I don't need to buy a property every day, but I need to buy properties in the future too. So if those investors come around in the future, great. Like I'm planting those seeds for the future. That's really my big takeaway when it comes to raising money.
Yeah, I actually have a quote on my whiteboard here. Raising money isn't about me. I'm providing an amazing opportunity for investors.
Yeah. And now you know you have a moral obligation to sell it to them.
Yes.
Awesome stuff, Flint. Listen, our audience can go to vestuscapital.com. There, you can see Flint's backstory, his portfolio. You can join his investor club. You can log on to his investor portal, learn about their multifamily investments, their build to rent strategies, and everything else. Check out vestuscapital.com. Flint, any other parting words or any place else that they should connect with you?
Yeah, I'm super active on LinkedIn. So if you want to engage and just see my educational stuff, /Flint Jamison.
Love it. Flint, thanks for joining us on Accelerated Investor. Thanks for being here.
Thanks, Josh.
Well, there you have it, guys. Listen, I really enjoyed that conversation with Flint, talking about the 3 phases of the build to rent community. Phase 1, buying the land and getting the entitlements. Phase 2, cutting the dirt, putting in the roads, the sidewalks. And then phase 3, building the houses. I love that idea because I know that a build to rent communities have very low maintenance. After you build it, it's got very, very low maintenance. So I'm super excited to learn more about that. Flint and I actually talked after we were done recording about possibly joint venturing on 3 of his deals. So I'm looking forward to that. And listen, guys, as Flint mentioned, as a lot of our guests mentioned, he was able to learn about build to rent through his mastermind, through his, mentoring program that he joined, through his partnering program that he joined. If you're not in one of those programs, you should absolutely think about joining our program. It's called Forever Passive Income, the Maverick Mastermind. You can apply there at joshcantwellcoaching.com. Also, if you want to learn more about multifamily syndication, raising money, doing commercial deals, but you want to just kind of test, dip your toe in the water, check it out, without making a big commitment, there you can buy a ticket to one of our online virtual live events. It's called Forever Passive Income Live. There you can go to foreverpassiveincome.com and grab a ticket for our next event. It's online. You can do it from home. You can listen in from your cell phone in your underwear. I'm sure you'll enjoy doing that. Listen, thanks so much for being here today. Don't forget to like, subscribe, rate, review, and become a subscriber to Accelerated Investor, wherever you get your podcasts, wherever you get your videos. All right? Sounds great. Hope you have a great rest of your day. We'll talk to you soon.
You were just listening to the Accelerated Investor Podcast with Josh Cantwell. If you enjoyed this episode and learned something new, help us build the AI community by leaving a review and 5-star rating on our iTunes podcast channel. Also, don't forget to subscribe so you never miss another episode. To see passive investing opportunities, visit freelandventures.com/passive. To start your journey toward the lifestyle you've always dreamed of with multifamily apartments, apply for one-on-one coaching with Josh at www.joshcantwellcoaching.com.